All right, so Bitcoin has just smashed through $125,000 to new all-time highs. Wow. But now that we're up here, the big question is, what happens next? Today, we're going to do something a little different. We're not just going to look at a chart. We're going to treat it like a crime scene, dusting for prints and looking for clues that tell us where the price might be headed.
So this is our crime scene. Every single candle, every indicator, every price level you see here, it's a potential clue. Our job is to piece it all together and figure out what the market is secretly planning. So here it is, the million-dollar question, right? Are we looking at the final, euphoric peak right before a big correction? Or is this just a pit stop, a place to refuel before the next massive leg up? Let's start digging for some evidence. First things first, in any investigation, you follow the money. We're going to look for the footprints of the big institutional players, what traders call the smart money, to see where they're really placing their bets. Okay, our first clue is the overall market structure. You can think of this as the basic blueprint of the chart. And right now, that blueprint is screaming bullish. We are consistently making higher highs and higher lows. The real key moment was that break past the old high around $104,000. That was the market's way of saying the bulls are absolutely in charge.
Next up, we hunt for liquidity. Now, think of these like hidden treasure chests on the chart, just packed with buy and sell orders. Smart money knows exactly where they are, and these zones act like powerful magnets, literally pulling the price towards them so institutions can fill their giant orders.
So, where are these treasure chests right now? Well, we've got two major hotspots. Just above us, past that $130,000 all-time high, there is a huge pool of buy-side liquidity. And then below us, hanging out around the $110,000 mark, there's a big cluster of sell-side liquidity. You can bet the institutions are watching both of these zones like a hawk.
Another huge clue we look for is something called an order block. Think of this as a historical launch pad, an exact area where institutions loaded up on massive orders right before a big move. Because of that history, these zones often act like a safety net, providing some serious support if the price ever decides to drop back down.
And if we look at our chart, we can pinpoint the last major launch pad. It's sitting right here, between $102,000 and $104,000. This is a super critical zone, because if the price does pull back, this is a very, very likely spot for those institutions to step in and start buying again for the next move up.
Okay, so we've tracked the big money. Now for part 2 of our investigation. Let's pull out the magnifying glass and read the more subtle clues from the chart itself. I'm talking about momentum and those key price levels.
Now, here's where things get interesting. While the price is making these incredible new highs, some of our momentum indicators are flashing warning signs, kind of like the check engine light on your car. Both the RSI and the stochastic oscillator, which are two key momentum gauges, are deep in overbought territory. This suggests the rally might be getting a little tired, maybe a bit overextended.
Just look down here at the indicators at the bottom of the chart. See how they're basically redlining, pushing the upper limits of their range? Now, this doesn't guarantee a reversal, not at all, but it is a key piece of evidence telling us that the probability of a short-term pullback is definitely going up.
So with all this in mind, you got to have a map of the battlefield. These right here are the key levels everyone should have marked on their charts. Above us, you've got the final boss, the all-time high at $130,000, and below us, we have a major support zone around $112,000, and of course, that huge institutional support level, the order block, down at $102,000. All right, for the final part of our investigation, let's zoom out a little bit. Let's see if history can give us any clues. We'll look at some classic chart patterns and some trusted data models to complete our evidence file.
Looking at the overall shape of this rally, it's actually forming a pretty classic pattern, something that looks like a rising channel or maybe an ascending wedge. Why does that matter? Well, historically, these kinds of patterns often show up in mature uptrends, sometimes right before the market enters a distribution phase where smart money starts to quietly sell.
And here's some more evidence that really backs this up. Using a classic tool called Fibonacci retracement, which is great for predicting where a pullback might stop, we can see it's pointing to a key support zone right between $108,000 and $112,000. Now, that lines up perfectly with the other support zones we found. And when different clues all point to the same spot, that's when analysts really start paying attention.
And one last, very subtle clue.
volume. As the price has been pushing up to these new highs, the trading volume has actually been going down. This is a classic signal. It suggests that the upward momentum isn't as strong as it looks on the surface, and it could mean that smart money is quietly selling their positions to all the enthusiastic retail buyers coming in.
Okay, we've gathered all the evidence. We've followed the smart money, we've read the chart's internal clues, and we've looked at the historical patterns. It is time to put it all together and deliver the verdict.
So, based on everything we've uncovered, the case isn't pointing to just one clean outcome. It's actually pointing to three main scenarios, and each one has a different probability based on the weight of all the evidence we just went through. Let's break them down.
So here's the final outlook. The evidence suggests there's a 50% chance of a short-term correction, where the price pulls back to that 110K support zone to refuel. Then, there's a 40% chance of just straight bullish continuation, just blowing right past the old high. And finally, there's a small, but still real, 10% chance of a major bearish reversal.
So this is really the key takeaway from our whole investigation. The evidence tilts just slightly in favor of a healthy pullback before the next major move up. While a direct breakout could definitely happen, all those signs of exhaustion suggest a brief cooling off period is the most probable path forward.
So what does all this mean in practice? Well, the most likely play is that the big institutions are setting a trap. They might push the price just above the old high to trigger a flood of breakout buy orders. Then they could use that huge surge of buying to sell their own positions, fueling a move back down to their preferred re-entry zone between 104K and 110K. That's the sequence you really need to watch for.
At the end of the day, the market is a grand chessboard, and the institutions, they've got their strategy laid out. Now that you've seen the evidence and you understand their likely plan, the only question left is the most important one: what's your next move going to be?